Hi, I'm Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And I know you're going to get tremendous value from the very seasoned gentleman we're interviewing today. Now, his name's jroll, and Jeremy's in right now, currently in about 70 opportunities that are worth more than $1 billion, but all passively, which is very unusual for this podcast because typically we'll interview active operators and syndicators. Jeremy has really taken this and done it in a passive role, but he's done it in multiple asset classes. In fact, he's so well respected and seasoned that he's an advisor to Realty Mogul, which is really one of the largest crowdfunding sites out there. So we're gonna have a lot of fun today. Jeremy, welcome to the show, my friend.
Yeah, thank you. Thanks so much for having me on. Really appreciate it.
No, and I appreciate you because you really have no agenda either. I mean, there's no gain here. And so I just think that's so cool. You're here just to add value. So can you maybe speak to, how you went from the corporate world into investing passively in deals and how and why that happened?
Sure, yeah. Thanks again for having me on. So back after the dot-com crash, for those of you who can remember that because it was a while ago now, I was sick and tired of the stock market for two reasons. One is a little more obvious than the other. Essentially, I was sick of the volatility. I'm a really slow and steady guy, and to watch it go up and down 30% in a year, it just was not for me. But the thing that bothered me even more was the lack of predictability for my retirement account. Not knowing where my account would be in 10, 20, 30 years really bothered me as a retirement strategy. So I basically looked at different ways to invest, and I came across passive cash flow. And what I concluded for myself was that to be low risk, diversified tenant-based opportunities like multifamily would probably be the best fit for me, looking kind of lower risk, more highly occupied buildings just for my own strategy. And I rotated my money from stocks and bonds, all of it, into cash flow between 2002 and 2007. And that's kind of how I got started. And I did not actually intend to get out of the corporate world at that point. I actually wanted the cash flow for predictability and the paycheck. But I had a last straw moment with my manager. I was actually working at Toyota headquarters at the time here in LA. And I decided to take the risk and leave for a year or two because I had the cash flow built up to live off of. And as it turns out, that was like the best thing that ever happened to me was that challenge because I've been out now since 2007. And I just love being a full-time passive cash flow investor. So
wow.
That's my quick snapshot.
Wow. Now, listen, I know you are in just about every asset class, office, retail. I think you said industrial. I think the only thing you said you're not in is hotels, and right. We're going to focus more on multifamily, but really passive investing as a strategy. The asset class isn't as important as really fully evaluating the deal, and they're all as far as from an equity raising standpoint, I think for the most part they're fairly similar. So, let's talk about what you look for in a deal. I mean, I know that right now in the market cycle, you're not really, you're not gung ho. You're really you pulled back a little bit because we're definitely in the irrational exuberance phase, but let's say we weren't in that place. How do you evaluate a deal? I'm sure you're very, very good at it at this point, but can you speak to that a little bit?
Yeah, absolutely. I'll try to keep it high level because that could be like a whole topic for today.
Sure.
But first thing I'll say is you made a very interesting point about the asset classes. To an extent, there is a lot of overlap when you're analyzing them on this side of the table. And what's really interesting is that I would almost put that aside and step one to me is who am I making a bet on? That to me is the most important thing. Whether you're investing in real estate, whatever, even a startup, I would argue who you're making the bet on is the number one thing. And then, the property, which is very important to me, is number two. It's just behind number one. And so what I'm trying to do is essentially, when I get a deal, assuming it meets my initial criteria, I'm trying to trust but verify, I would call it. Meaning that as you being a syndicator, you're the expert. I actually couldn't do what you do, and then I can't go buy an apartment building, either from a credit perspective and from many different perspectives in terms of analyzing, getting on a contract. I've never been through any of that. My job is to analyze what you've done and make sure that I'm kind of trusting what you've done as the expert because you know much better than me, but also verifying. And really, in the end of the day, I'm trying to find people who are conservative, just to match my own personality, who are looking to under promise and over deliver based on how they put their projections together. And that's like someone who's trying to build long-term relationships with investors like me versus someone who's being aggressive, using very aggressive numbers, and is essentially overpromising to make the numbers look good to get investors, but may or may not perform in the end of the day and may not care whether I invest with them again. And so
there's a lot of that going on right now. I'm just telling you, I mean, a lot of that going on, and operators not stress testing deals. We were on, we were on a call a while back, and Robert and I, and Robert is my partner, and asked the operator, so how'd you stress test this? And it was crickets. It's like, okay, well, so you're expecting everything to just go fantastic for the next five years.
Exactly. So, it's, and I kind of try to read between the lines a little about how an opportunity, like a summary, is put together. Is it telling me the person's aggressive or not? What assumptions did they use, right, to really understand if they're being aggressive or not? And then, of course, so once you assess the person, right, then you have the second question is it the right property for you? And you can look at some high-level stuff very quickly to filter out deals in terms of projected cash flow, returns, whatever your criteria is as a passive investor. There's all different ways to invest. In the end of the day, though, you want to evaluate who you're making a bet on, and you want to evaluate is the property and the business plan associated with the property something you actually believe in. But I do want to stress who you're making a bet on. It's so important because I like to tell people that I trade control for diversification in the way that I invest, okay, as a passive investor, but I am giving up control. The reality is that I put a small piece across a lot of things, and each time I put in a small piece amongst many other investors, I really don't have control. I have a very small vote. And so who I'm making the bet on is critical.
Yeah, I've got a list of questions that someone should ask a passive investor, and number one is, who are the actual sponsors of KPs on the deal? It is the number one question, and what's their experience? How long have they been doing real estate? And there are lots of dig deeper questions on that, but the bottom line is, who are they? And certainly the property would be next. And so let me ask you this, without getting too micro, can you give some high level parameters that let's say you get a pro forma, and what are some red flags that jump out at you right out of the gate? Can you maybe we can start with that?
Absolutely. So now keep in mind, I invest a certain way for my personality, and I have certain cash flow targets, et cetera. So everyone,
in fact, speak to that for a second, because we spoke about that before we started recording, and I want you to share your model so that people understand that as it relates to this conversation. Thank you.
Yeah, sure. So I typically invest in Class B assets in what I call a B market. So I tend to avoid hot markets or like a Los Angeles where the cap rates are really low and the cash flow is low because I look for cash flow. So I'm investing mostly outside of California, across the U.S. I tend to target stuff that's 80 to 100% occupied, stabilized, and may or may not have any value add upside whatsoever. That's completely optional to me. The best way to frame it is I want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. So I'm looking for predictability. And I also love tenant diversification. So in an apartment building, for example, my rule is that I want to be in a building that's over 100 units, just because if one person leaves tomorrow, then not much has changed, which is going back to that predictability. So that's my own criteria typically.
Interesting. And I know you do retail and things like that as well. And of course, you want tenant diversity there as well.
Yes.
But in multifamily, 100 unit plus, you can sustain a few vacancies, right?
Yes, and what I've done, it's interesting, the way I've handled this cycle as it's gone on is that I've had specific cash flow target criteria, and if a deal doesn't meet that, then I typically will pass. And so it's very unrealistic right now with the way cap rates are, okay, because of where we are with the exuberance you had mentioned. So I have been targeting a minimum of 9% cash flow projected net to investors year one, and 11% averaged annualized cash flow projected net to investors. That's not including mortgage pay down or assumed depreciation. You know what it takes. That takes a pretty high cap rate. And what that's done is that it's kept me what I call out of trouble in terms of not paying too much of a multiple for a property. And it's also kept me on the sidelines a lot, especially in the past couple of years.
Sure. Yeah. I mean, that's higher than ours. We look for, our minimum is 10% annualized cash on cash for 5 years. Now now sometimes, because we do value add, sometimes that first year is 5, but then we make it up on the subsequent years.
But I want to be clear though, that my targets right now are completely unrealistic. And I know that.
You said that. And yeah. Okay. Now how important, I mean, talk about the IRR. What sorts? How does that come into play?
Yeah, it's a great question. So I focus very heavily on the cash flow because that's what I live off of. So I'm looking for, and when I put $1 to work, I want it to hit a certain cash flow criteria because I'm living off that. And every dollar I don't put to work within my cash flow criteria, everyone's got a limited amount of capital, and I've got to be really careful with it. So the IRR is a lot less meaningful to me, to be honest with you.
Yeah.
Now, what's interesting, though, is that when you have a deal that cash flows at a certain amount with a certain occupancy rate, you're fitting in this specific box that I've created, you're typically going to see a typical ROI in the 15 to 18% range, just kind of like everything lines up to that. And then IRR might be, 14 to 16 or 17. But again, I am not an IRR investor. Most people are, and especially value add, you're going to be, right? But that definitely makes me a little bit different. I'm very heavy on the cash flow focus.
Interesting. So okay, so you look at that. Any other red flags that jump out?
Yes, for sure. So one thing you want to look at immediately is the terminal cap rate, or the cap rate that was assumed that you're exiting at after a certain number of years.
Exit cap.
Yeah, that can really change the economics of a deal, and especially the ROI, and to an extent the IRR, depending how far out it goes. That's one for sure. Right away, you want to check.
You want to see an increase, and you see some of these deals that have no change in the entry and the exit cap. You're like, come on.
Especially right now, right? That's especially right now. You want to take a look in apartments specifically. You want to take a look at the expense ratio, and you want to make sure that it's actually in the right range, just as a quick first look, right, as a flag. And you've got to take into account which climate you're in. There could be more heating expenses, et cetera. You want to look at who pays for utilities, et cetera, because that can affect things. You want to look at the type of asset class it is. So a Class C property may have a higher expense ratio than a Class A property. So you want to adjust for everything, but definitely look at the expense ratio, because what the expense ratio is telling you is how conservative has a deal been projected out.
Yes, right? yes. Okay, guys, I want you to hear what he just said. He's a very fast talker, and I want you to miss what he just said. If you see a lower expense ratio, it's someone on a pro forma, it's someone being aggressive. It could very well be way too aggressive. So talk about a range that you like to see in the different scenarios. Just I know this is way high level, but.
Yes. So you're talking about an expense ratio?
Yes, expense ratio,
okay.
Yes.
So on a Class B asset, I would say that I'm most comfortable between 45 and 50%. If it goes below 40, like even below 45, I'm going to start to ask questions. If it goes above 55, look, it's in some cold areas where it's a harder tenant base and stuff, I could see it go up to 55, which is kind of rare. But if it goes above 55, I'm going to be asking questions. If it goes below 40, for sure, I'll be asking questions. If it gets towards 40, I'll be asking questions.
Yeah.
But what's really critical is that when you look at that and the terminal cap rate, you're starting to see people who could potentially engineer numbers that are looking better than they should be, right?
Yes.
So those are some of the flags at a quick glance. Those are the really easy ones.
Yeah.
You're going to want to look at the expense inflation assumption on average, and then the income inflation assumption on average. And it might differ by year.
What sort of averages? I'm sorry. You're moving really fast, and this is probably making a couple of the people on the podcast head swim a little bit.
Sorry.
So let's start with the income inflation, which guys, so what he means by that is just what percentage are you throwing in on a pro forma per year that you anticipate the rents to increase? So what do you like to see there?
Jeremy? So keep in mind, I'm investing in a stabilized deal, so I wouldn't expect to see 10% year one, right? Because that doesn't really it doesn't equate. So I would say that 3% is a fine number for me.
The average.
Anything under would flag as being very conservative. And if it's 2 or something, I may even ask why it's so low. Anything above 3, I'm going to start to question, is this person being aggressive? Are they trying to make the numbers look good?
Okay.
For an expense inflation, I would say as an average, I like to see 2.5 to 3. But I really dig into the line by line, because you know this very well. You may have often I'll see someone's paying medical expenses for employees, for example. And then those medical expenses, it might be best to assume that they're going to have a higher inflation rate, for example. But if they don't assume that, then they could be understated. So, we're giving averages as a high level, but I would say that 2.5 to 3 is a really nice area.
Okay. Anything else pop into your head just at
a quick glance? I'm just going through it. These days
you've done so many of these. You can just think about it. I'll tell you, we can move past.
One very important thing I forgot to mention. One of the first questions I ask right away, because of the way that I invest, is the cap rate. And if the cap rate is under a certain number for me, I automatically pass. And partially because I know that within my profile, it won't hit the cap. I don't even have to look at the cash flow. It won't hit it, if you're taking a normal loan. So that's another one I would very strongly recommend looking at.
Okay. So what are some other questions that you might ask an operator when you're considering
getting involved in one of their deals? What are let's go down that. It's the big ones, the ones that you really give attention to.
Sure. Well, one thing I want to mention right off the bat is that I always do background checks. And I do it on all the managing members of the manager entity. And I say this right off the bat because I find most passive investors I network with do not do those. And it has saved me a number of times. And I think it's one of the most overlooked things when someone evaluates a syndication. So I always do background checks. That's number one. Now, I actually don't normally do that until one of the last steps because
it doesn't cost money.
Exactly. And I want to make sure everything else lines up first and make sure it's the right deal to really do that on.
Sure.
Another thing I'll do is I will absolutely try to verify the operator's experience clearly and their track record. And what's really important is, we're seeing an interesting time right now because we're recording this in 2019. And if somebody started in 2012 and everything's gone really well, then
they haven't had their butt kicked yet. They didn't go through what you did personally. You said you started in 02 to 07, so you probably saw some pain. Maybe not personally, but maybe some of your investments pulled back. Yeah, if that's where you were going with that, right?
Right. So my point is, though, don't be confused with if I see an operator started in 13 and currently has a pristine track record up till 19, all that does is check the box that that's the way it should be. Not that's actually a bonus. Actually, any yellow flags or red flags coming up during that time period, almost it gets magnified in my head because they shouldn't be having trouble at this point in the cycle with the way the economy's been and the expansion and reduction in cap rates, et cetera. So it's twice as bad, I suppose, if you see that type of scenario. Sometimes I'll actually ask questions where I don't even care what the answer is, but I actually ask it to see if they're conservative or not in the way they answer.
Give me an example.
So what's a good answer? So this is a kind of an obvious one, but it'll give you some idea what I'm talking about. So let's say that the current building is 97% occupied and they assumed an 8% vacancy rate, across the board. I'll say, well, why did you assume this? How did you get the 8% vacancy rate? They may say, look, we're in a really strong market. We think we're going to continue to be at 97, 98% occupied. We want to be conservative and make sure we set up the right expectations for investors. That's what I would expect to hear. On the contrary, if the property is 85% occupied and they're modeling out in year one 98 and they're going out 97 all the way through, for example, then I'll ask them that question. If their answer is, well, we're in a really strong market, it's going to be strong for the next few years, the data shows it, blah, blah, blah. What that's telling me is that they could be right, but they're being very aggressive, and that's not the personality I'm looking for. So again, in that case, it's a little bit. That's not really the best example because
that's what you mean by that. You're looking for that that personality that matches yours, which is very conservative. Got it. I mean,
So reading between the lines on the way the sponsor answers some of the questions is sometimes more important than the actual answer itself. Is my point, and that's definitely some of what I do for sure. Because I ask a ton of questions.
Sure.
Yeah, one of my favorite things to do, because I typically go on site, depending if I've invested with someone multiple times and it's a deal that's easy to analyze from afar, I may not travel, but I usually will travel. One of my favorite things to do is to get a tour from the sponsor of the general area, not just the property. Because what that tells you is how detailed is the sponsor. Are they eager to show you this building, that building, looked at this, this, they depend on the asset class, and this was a comp, this isn't a comp, this one has rents 20, if they really know their stuff, they've done a ton of research, you can tell. And then on the flip side, they just take you to the property, walk you through the property, and then that's it. And they don't know much about the area. That tells you something about them too. And again, this is reading between the lines, right?
Yeah.
So I do a lot of the reading between the lines because in the end of the day, it's who are you making the bet on, and have they done their research because they're the expert that you want to make a bet on and trust.
Nice. So, okay. What are some other things, other questions that you might ask if you've never done business with a particular operator? Any other, even maybe drilling down a little bit more?
Yeah, I mean, basically, I want to understand their general strategy, what they've done in the past. Does that align with what they're doing today, or do they have to switch? And if they have to switch, why? Which sometimes can be for a very good reason if they're switching strategies. I definitely would want to understand how they've handled the cycle and how they kind of manage a cycle. Because I can tell you personally, I switch when I'm investing in depending where we are in the cycle. It's very specific and very strategic, and I try to stay away from what's hot. And I can switch asset classes, which is one of the advantages I have on the passive side.
Right.
And so I'd like to hear, what the sponsor's been up to. Have they been mostly on the sidelines? By the way, when did that start? Do I agree with their timing or not? What cap rates are they willing to pay? That's a very common question. So I get an idea of how aggressive they're willing to be within the type of framework and risk profile that I'm looking for. And how many deals have they, so, I may ask somebody, how many deals have you done this year? And see if, so how picky are they being, right? Because we've talked about this a little before that, now is the time to be ultra picky. And if someone's doing a ton of volume that just flags up, that's really not okay. It's just not in alignment with what I currently believe we are in the cycle. So those are some more sample questions, just trying to get to know somebody and make sure they're the same philosophy.
Okay. I mean, do you speak to their communication plan for investors? Like us, we take a lot of time educating our investors. So we'll do webinars and kind of show the behind the scenes stuff. And of course I do live events, things like that, but there's so many things I can't teach from stage that so we kind of do include education, and then we do regular reporting, a narrative and included with webinars. So what do you look for?
Yeah, great. So that's a really great point and topic. So first thing I'll do is I want to confirm that distribution frequency is what I look for, which is typically quarterly. I don't expect it to be more often than quarterly because it's very burdensome administrative for the operator, but I need the quarterly cash flow because I live off of it. So that's my minimum. I also look for quarterly reporting, right? And to your point, one very important thing I think a lot of investors don't do in advance is ask for a sample quarterly report from the past. They can redact it if they want, if it's confidential or whatnot, but that will give you an idea of what level of communication to expect. Because let me tell you, I have seen the entire spectrum of communication, and you, as an individual, as a passive investor, you may have certain, what's the word I'm looking for? Not requirements, but you may have a certain expectation is what I'm looking for, right? What am I going to get about this property every quarter? Some operators will give you 10 pages, some will give you 1, and you'll see everything in between. Now, one thing you're going to know is, looking at that quarterly report, do you agree with the level of information you get? Are you comfortable with it? Because if you're not comfortable with that alone could be a reason not to invest with an operator, even though you love a property. You have to make that decision. So asking for that quarterly report in advance is really, really important. And I find a lot of investors don't do that. I always do.
Right. No, that's one I hadn't even heard myself. So that's very important. I like it. I like it a lot. Do you dig into how an operator has stress tested a deal? We talked about that, do you look at how much of an operating reserve they might be raising or keeping in the deal? Do you ask what ifs that they may have done, as to decrease in occupancy or decrease in rents or, a combination of the two? Do you dig into that at all?
Yes, for sure. So first thing I do is I'll definitely look for an line item that will be like a reserve. Usually what I look for is a reserve per door, so to speak, on the multifamily side. Now it depends too, because if there is if there's a plan upon closing to make some improvements, take care of some deferred maintenance, some of that cost will be up front, but you want to see a reserve ongoing. You just want to see that to be conservative. So that's one thing I'll definitely look for. There was another thought I had in my head that I'm blanking on.
Well, do you ask them what they did to stress test for higher vacancy and things of that nature?
Yes, I always do. And one very important question to ask is, at what occupancy rate are we at break even from a cash flow perspective? Okay?
They better be able to answer it.
Yeah, very good point, right? And by the way, that's another great thing of reading between the lines. Oh, I don't remember. I don't know. How much are they really, how much research have they done on a deal? Sometimes they'll publish a sensitivity analysis. Sometimes they won't, but they may actually have done it. And so it's very important that you get a sense of whether someone's been that thorough or not by asking those types of questions. Another question I like to ask is, at what occupancy rate are we below the debt service coverage ratio that the bank will actually allow? Unfortunately, I've seen a couple funds recently that a friend was in, where their debt coverage rate in this economy right now, their debt coverage ratio is going down, and they're breaching the covenants, I'm sure. And by the way, a lot of investors don't realize that once you're below that debt coverage ratio, the bank can actually withhold all distributions. They can actually can require the sponsor to not distribute any cash and just reserve everything until they're back above. And so that will mean zero cash flow for someone like me, which is a huge problem, right? And so those are very important questions to ask as well, so you can understand some of the risks as an investor, obviously.
So
if you were speaking to people that have not invested passively yet, what advice might you give them to educate them? Because I try to push them to come to my events, at least have a basic understanding of the business and how to analyze a deal, and at the, you know, because so many people will just blindly give their money to someone and then not fully understand what it is they're investing in. I mean, a great example of that, of course, is the stock market, with stockbrokers that are great at selling but haven't got a clue of what they're selling. But, you know, so it's my belief that you should understand as much as possible anything you invest in. Now, you're on the opposite end of the spectrum. You understand it probably better than many operators do. But what would you suggest to someone that's listening, that's got, you know, maybe sitting on some money that they're thinking about investing?
Yeah. So I would say number one is real estate is typically cyclical. So you and I talked about some exuberant phase, and
right.
It's important to understand that real estate is cyclical, and you've got to take a step back and educate yourself on where you think we are in the cycle. Everyone's going to have their own opinion. And does that mean you should be aggressive or not right now? I am mostly on the sidelines, not fully. There's always deals out there. There's always unique opportunities, right? But that's number one. Really get a sense of how dangerous is it to invest right now? What do you need to do to protect yourself, depending where we are in the cycle? Number two is, if somebody's starting from scratch, the best way they can learn, at least besides getting education like you're referring to, is what I call opportunity exposure. That's how I learned. And it was much harder to do when I first started in 2002 because you have to network to find all the deals. If you're talking about an accredited investor, you can log on to the major crowdfunding sites right now in your pajamas, and in an hour you can download 10 multifamily deals, put them all next to each other, and start to compare them. Even if you know nothing about how to analyze them, you can prefer returns, splits. You can look at the expense ratios across all of them, and you can start to learn a little bit about it. That's how I learned. It's all opportunity exposure.
Fantastic.
Yeah, and it's actually really efficient these days. It's much easier than when I did it. So that to me, you know, is one of the best ways I think to learn. And also recognize that it takes time. And like you mentioned, it's not something you want to jump into. These are not, you can't just press sell on your screen and sell in 3 days in the stock market. These are illiquid. And you're making a commitment. It's not so easy to get out of these, and it's not something you probably want to do unless you're in an emergency or some type of reason. So you want to put a lot of time and thought into this before you actually start down the path.
I couldn't agree more. Well, listen, my friend, you've added tremendous value today. I really appreciate you taking your valuable time with no agenda other than to add value, Jeremy. And you know, it's an absolute pleasure to meet you, and really very, very impressed with your incredible knowledge of this exciting business that we're in.
Yeah, thanks for having me. And then, you know, can I mention, if someone wants to contact me, I'm happy to help people if they want to or whatever.
Yeah, sure.
Easiest way to reach me is through email, which is at jroll which is JROLL at Roll Investments, which is ROLL Investments with an S.com. So jroll at rollinvestments.com. I'm happy to help anyone any way I can. The networking, if you're new and have more questions. I'm not an investment advisor, so I'm just going to share my perspective as an investor, but everyone's welcome to reach out to me.
Very kind of you, but be careful what you wish for. I'm in a lot of ears. Okay, thanks for being on the show, my friend, and I'm sure that our paths will cross again.
Sounds great. Thanks again for having me.
Thanks. Hey, thanks for watching. Please subscribe to my channel, and if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through Real Estate Investing.